presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Asset Management YouTube update for October the 18th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. And don't forget to tune in to the daily broadcast 1 hour every day where we review the markets on a daily basis. Today I'm going to talk about the Fed, where we are right now, where we're headed, looking at and that's going to really drive the market. It's inflation that is driving the Fed, and the Fed is driving the stock market. Really the economy and the stock market. So we'll take a look at the market, the economy, the technical analysis, where the market meter is as far as the recession is concerned, outlook for the week ahead. Let's start with the Fed. They're still looking at, this is the Fed dot plot right here. They estimate that they're going to see a 4.6. Remember, we are at 3.725 to 3.5 right now as far as the rate is concerned. That's where we are right now. So expectation is we're going to rise by 75 basis points in November and then another 50 basis points in December. That'll put us somewhere around 4.5 to 4.75. After that, what happens depends on inflation, what the Fed wants to do, and depends on how slow the economy is getting. And it really is not getting that slow. Biggest driver of the economy is unemployment. You've heard me say on the daily broadcast on the Market Wrap that I've talked about how I believe that the recession is really going to come when unemployment goes up. That's when America stops spending money. Right now, we're still spending money. So far, it's been a recession for the one percenters, as I call it, people who own stocks and people who own the real estate market. But the average in America, they only have a recession when jobs start to disappear. We're still at a 50-year low. So unemployment has to go up before the Fed really starts taking the foot off the brake and seeing the economy slowing. Inflation is still running hot. We're still seeing the number that we got last week, just about 8.2%. A lot of it is coming from energy. That has gone down, but the biggest part is shelter. That's one that you've heard me talk about quite a bit over the last few months, that I expected that to pick up, and that is really happening right now. Looking at the markets, this is what happens after market bottoms. After average bear market, we see the S&P. This is what it does. We do have a lot of false starts where it looks like we made a bottom, come back down. Looks like we make a bottom, come back down. So we get these bear market rallies on the upside, and we've had a few, and we don't know if the one we're in right now is the beginning of a bear market, another bear market rally, or the beginning of a bull market. No one knows that when the trends change. A lot of people go chasing, oh, that's the bottom, then the market runs up, they feel good, it comes right back down, and they get stopped out again. I like to see the bottom in the rear view mirror. I like to see the market going up. Looking at the average length of a bear market, it's about 14 months. That's what we see, the average. You can see that we're already into the 10th month of this bear market. Last one was in 2007 to 9, that was 17 months. The 2020 was a long one. 2002 was a long one where we did see about a 30 month. But the average is about 14 months, so we're about 3 or 4 months from the average. Will this be a short bear market or long bear market? We'll have to wait and see. The asset class performance following bear markets, small caps take off, international does well, U.S. large caps do well. That's what we've seen. And if you look at the average return after a bear market, 12 months later, inflation peak 12 months later, the average return on the S&P is 16%. After a bear market, the next 12 months, the market gains 30%. So if you're down 25 and the market goes back up 30, you're back to even or ahead from where you were prior to the bear market, and you still have some stock that you picked up at lower prices than where you sold. Looking at the economy, we're still looking at exports of LNG. That's going to come to the United States. We're building a lot of plants to liquefy natural gas, to liquefy it, send it over to Europe, but then they have to build plants to deliquefy it. They're in the process of doing that, but it takes years to get that supply chain and the plants built. So it will take time. We still have some that are already approved, one in Texas, one in Louisiana, and there's quite a few that are under construction right now. So that are approved. So we will see. They're not approved yet. They're not under construction. They are approved. So we are going to see a lot more LNG plants built that are going to liquefy, and we are going to become the major suppliers of energy to Europe. Retail inventories, that's last year. It was all supply chain. We could not get enough product into the country. So all the companies ordered a lot of stuff, expecting that they won't get it. All the stuff now, as the supply chains untangle, we're seeing inventories go up because all of the ordered materials are coming in, but demand is starting to slow down. That is why we are seeing retail inventory especially shoot up dramatically. Retail sales are up, but not at the same pace. So that's where we're going to have the disconnect again. That will bring apparel prices down. The retailers have to discount this quite a bit. So we will see how that holds up. Consumer confidence hit a low, but I don't know if it's really going to take off. It really goes with gasoline prices. And gasoline prices go up, confidence goes down. Gasoline prices start going down, confidence comes back up. So that's what we've seen. We're close to it. Don't forget to get the daily edition of Market Wrap. You can go to the App Store, type in one word, Market Wrap with Mo Ansari, and my app will show up. You can download it, and then you'll get the daily edition on a daily basis. Looking at the technicals, I'm still looking at about somewhere around 4.5% for the 10-year. We're sitting today at just about 4. So I expect this. We should get a little bit of a pullback in the 10-year yield. This is the yield on the 10-year note. So you can see it's right at about 4% today. A move above 4 right here should put us in somewhere around 4.25 to 4.5 is what I'm looking at. S&P fifth wave. Everything moves in 5 waves. 1, 2, 3, 4, 5. Once you see 5, that's usually the end of the move. Today we popped back above 3,700. This is the 20-day moving average right here, which is 3708. Market is trading right now. I'm doing this on Tuesday morning. We're at 3710. I'd like to see the market hold the 50-day, get above this 3,800 right here, which is the triple top before we went down, made new lows, and then get above 3,900, which is the 50-day moving average. So these are the resistance areas right here. We're at 3708, 3,800, 3,915. Until we get above 3,915, this is just another bounce in the bear market. That's the way I'm looking at. But on the weekly charts, we're starting to look better. You can see that we've completed the fifth wave at the beginning of this year, ABC correction, and now we've got a divergence on the moving average convergent divergence. This, as you can see, the market has made lows right here. This is the MACD. This is right here. Now the market has made a new low right here, but the MACD has not. And you can see we're close to a positive divergence where the technical indicators have not gone to a new low, but the market has. That usually gives us some sign of a turning point, but again, we need to get above 3,900, the daily numbers. Looking at the Nasdaq Composite, target was 10,100 to 9,900. Well, we hit that target last week. We got exactly to 10,088 was the low, and we popped up from there. Here we are above the 20-day today, or close to it. It's 10,750. We're trading at right now 10,754. We need to close above the 50-day, above the 20-day, and the 50-day moving average. Once we get above the 50-day, that would be a positive sign. So far, looks like we've gone through this correction, this ABC correction, but we need to hold these lows and really get some momentum on the upside. On the weeklies, again, ABC after making the fifth wave top, we're looking at a fifth wave bottom, and it looks like a new low right here that we made last week. It looks good, but we need to get above 11,000. 11,068 is what 168 is what I'm looking at right here, the 200-week moving average. Oil prices went up, but they're not playing a lot of technicals. It's all going with fundamentals. How's the economy doing? The day we get numbers, economy is not doing well. Oil market goes down. Economies are doing well. Oil market goes back up. Looking at the gold, we hit the 50-day right here, 3 days in a row, just like we did on the stock market with the 20-day, and then we fell right back down from there. 1615 is the target on the upside. We're trading around 1654 right now. So the market is bouncing. Will depend. We'll have the inflation number still higher. Fed is expected to raise rates by 75 basis points on November the 2nd, another 50 basis points. That is already in the market. Now, how much does the economy slow? How much does inflation slow? That's when the Fed starts to take the foot off the brake. How much does unemployment go up? right now we've seen a peak in inflation, but it's coming down very slowly. We're seeing the economy doing well. We're getting earnings reports, and they're not as bad as everybody thought. And that really makes us feel that, okay, it might be a mild recession depending on demand, but the Fed is still stepping on demand, trying to slow the economy. And we have not seen the effects of all the interest rate increases that have already been put in place by the Fed. So next couple of months, we're going to be choppy, but it's an opportunity where some of the stocks that are down 40, 50%, good stocks, if you do not have them already in your portfolio, that's when you want to start adding those. Looking at the market, we're right about here, should be about 65%. That's what it should say. That's the chances of a recession, and that's what I'm looking at still. They've gone up a little bit. And don't forget to sign up. You can go to compak.com and you can sign up for Mo's Market Minute, where I'll give you a weekly update where you can get that newsletter downloaded automatically to you. Those are my views looking at the week ahead. A lot of earnings reports, but not a lot of economic data. But we'll have to wait and see what the Fed governors, they'll come out and start talking and giving their ideas on where they think interest rates are headed. And that, I think, will drive the market over the next week or so. But it is earnings. If earnings still hold up and the guidance still holds up, that would be a good sign and could give the market an opportunity to rally in the short term. Those are my views. Those are my thoughts. Thanks again for tuning in to the weekly edition of the Compak YouTube Update.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.